This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the second lecture of several on investment appraisal. This one's on chapter 12 of the free paper P2 lecture notes. In the previous chapter, we looked at two very simple ways of making the decision, looking at accounting rate of return and payback period. This chapter is the first of a few on discounted techniques, primarily net present value, which is by far the most important of the three techniques, by far, and is rather more involved. That's why there are several chapters. And a discounted cash flow approach, first of all, we base our decision on cash flows, not on profits. And the reason being, it's cash that we need to expand the company, to invest in new machines, not profits. And equally, it's cash we need to pay the dividend. I know by law you can't pay a dividend more than the profit, but if the company hasn't got any cash, they can't pay dividends. It's cash that matters, both to be able to keep the shareholders happy, giving them a dividend. It's cash that matters if we want to expand the company. We need cash to buy new machines. So it's based on cash flows. And the basic idea is very simple. Quite frankly, all we do is we say, well, how much cash will it cost to buy the machine? How much cash do we expect to get back from the machine? And if we get back more than we pay out, it's worthwhile. If we get back less than we pay out, it's not worthwhile. We simply bring in one extra factor, which is what we call the time value of money, relating to the fact purely that money costs money. If we're having to borrow money to buy the machine, we're having to pay interest on that money. Even if we've already got the money, it could be earning us interest. And if instead we invested in a machine, it's still costing us because we're losing interest we could have had. And so I'm going to start off by making up the simplest example of all, just to make it clear what I'm talking about, because although in the exam it becomes very mechanical, to a large extent you learn rules, it really is important that you know why we're doing it. Just suppose I told you we had a machine which would cost now 10,000, and it'll just give us one cash return. We get a cash return in 2 years' time of, let's say, 11,500. Now, clearly, we're going to have to deal with situations far more complicated, but I just want to use this to make it clear what I mean by the time value of money. So it'll cost 10,000 now. In 2 years' time, we get back 11,500, and that's the end of it. Well, were it not for one factor, there's no argument. You pay out 10, you get back 11.5, so we've ended up with a cash surplus of 1,500. And I said earlier, it's the most simple idea of all. If we get a cash surplus, it's worth doing. A cash deficit, and it isn't. However, that 10,000 we're using, again, either we've had to borrow it, and there's interest payable on that money, or, alternatively, I have the cash sitting around, but it could be earning interest. If we invest in this machine, we're losing interest. And suppose I tell you the interest or the cost of capital is 5% per annum. Well, if there was no interest, we've made a surplus of 1,500. If there is interest, surely the surplus will be reduced by the amount of the interest. And there are actually two ways we could deal with it. One way, perhaps the most obvious, would be to say, okay, you're borrowing 10,000. After 1 year, There'd be interest on it at 5%, which is 500, so you're then owing at 10,500. But we're having to wait 2 years before we get any money back. So the second year, there's another 5% of 10,500. Oops. So the interest of 525. And therefore, at the end of 2 years, you'd be owing 11,025. At the end of 2 years, we get back 11,500. Well, if we end up with a surplus, fine, it's worthwhile. Deficit, it isn't. Well, of course, there is a surplus. We end up with 11.5. We owe, after accounting for interest, 11,025. There's a surplus of 475. It's positive, it's a surplus, we would accept. If there was a deficit, after dealing with the interest, we would reject. Now, that's one way. And we say what we're doing, adding on interest, we say we're working out the terminal value. And of course, I could have got that 11,025 slightly quicker. We borrowed 10,000. Adding on interest for a year, well, instead of taking the interest and adding it, if you multiply by 1.05, that's giving us 10,000 plus 5% of 10,000. So that gave us 10,500 after 1 year. To add on another 5% of 10,500, multiplied by another 1.05. And that would give us directly the 11,025. 0.05 because it was 5%, squared because it was 2 years. Now we could do that to give the right decision, but when we get more complicated ones, that gets messier. So what we always do, same idea, but what you might call in reverse. We say, okay, it will mean paying out 10,000 now. We will get back in 2 years' time. What was the figure? 11,500. But instead of adding on interest, we in a sense work backwards and we say, well, that 11,500, how much now would have grown to 11,500 in 2 years' time? And then before I said, if it's X now, in 2 years' time, it'll have grown to 1.05 squared. Multiplied by 1.05 to add on 5% interest. Twice squared because it was 2 years. Well, I want that to equal 11,500. So we say, well, the equivalent amount now, we divide by 1.05 squared. 0.055% squared 2 years. And that gives us an equivalent amount now of 10,431. That 10,431 now is equivalent to 11,500 in 2 years. And so he's saying, well, it's like paying out 10,000 now and getting back 10,431 now. It gives us a surplus of 431. It's not the same as before. That 475 was a surplus in 2 years' time. 431 is the equivalent surplus now. But what matters is, if it is a surplus, if it's positive, we will accept. We're getting back, oh dear, I think the screen's got too hot. There we are. No. I won't try and write it there, I have to imagine it. We will accept. And had it been negative, deficit, get back less than we were paying, then we'd reject. So I'm sorry going on, especially if you've seen this before. It depends very much when you studied P1. But it is important, you know what's happening. We'll make it more interesting in a minute. That's far too basic for the exam. But that's what we're doing. When we talk about the time value of money, we're talking about the cost of money. It's something to do with inflation or anything. I can mention that later. It's the interest cost of money. Just two final things before I leave this one. We call the equivalent amount now, we call them the present values. And that 431, for obvious reasons, is the net present value, or NPV. We divided by 1.05 squared. Normally, though, instead of put divided by, same thing, but we say we multiply by 1 over 1.05 squared, which may look a bit silly. The end result is you divide, but we always say we multiply by that number there, and we call that the discount factor. And finally, on my baby one, although what I've done there is correct, and it's easy enough to divide by 1.05 squared, although we can always do that, in a fuller question, as we're going to gradually come to, it's a bit time consuming. And so, instead of having to work that out ourselves, you are given tables. If you look at the beginning of the notes, they're on page 3. In fact, you get two sets of tables, present value tables, annuity tables. If you look at the present value tables, they will tell you the discount factor, the number we multiply by, for any rate of interest up to 20%, for any number of years up to 15. And so that's 11,500. The present value, instead of having to divide by 1.05 squared, we can just multiply by the figure from the tables. If you look at the 5% column, if you look at the 2-year row, it's 0.907. And that'll give us the present value directly, 11,500 times 0.907. 10,431. Now, the tables are rounded to 3 decimal places, so it will quite often give slightly different answers due to rounding. But in the exam, use the tables, not really worried about rounding, but use the tables unless you're given a rate that isn't in the tables. If you were asked to do it at 4.5%, well, then you'd have to divide by 1.045 squared. You'd have to do it by first principles. And the formula is at the top of the tables anyway. So, sorry spending time there. Let's make it slightly longer. Can you turn to the first exercise in the notes themselves? Exercise 1. A machine will cost 80,000. It has an expected life of 4 years with an expected scrap value of 10,000. The expected net operating cash inflows, it's like the profits each year, but in cash terms, it's a cash measure, are 20,000, 30,000, 40,000, 10,000. Well, what's the way I set it up conventionally? And then we'll do the numbers. Now, we're going to pay out now 80,000. We always treat that as times 0. That's today. So an outflow, but in brackets 80,000. We then get cash receipts, net receipts, inflows of in 1 year 20, in 2 years' time 30, 3 years' time 40, 4 years' time 10, and then in 4 years' time we get another 10,000, the scrap value 10,000. And by all means, we just put those two together and say it's 20,000. Again, if there was no interest, it'd be obvious. We pay out 80, the total cash back, 50, 90, 90, 100, 110. There's a surplus of 30,000. But of course, there is interest. The cost of capital is 10%. And so we want to work out the present values in each case. We'll multiply by the discount factors. 80,000 now is 80,000 now, no problem. 20,000 in 1 year. I've lost my tables. Where did I put them? Here we are. 20,000 in 1 year. The discount factor, the 10% column, the 1 year row is 0.909. And so the present value multiplied by 0.909, 18,180. And similarly for all of them. For 2 years, the factor is 0.826. For 3 years, 0.751. The factor for 4 years at 10%, 0.683. And so multiply out the present values, 24,780, 30,040, 6,830, 6,830. The net present value, NPV. Add up the inflows, subtract the outflows, so 18,180, 24,780. That's 6,660. And it's positive. The fact is positive means we make a surplus after accounting for interest and therefore we'll accept. Again, were it negative, we would reject. No problem. You'll see the problems later aren't so much in the arithmetic. That you can learn and that's not hard. The problems we're coming to later is how do we actually arrive at those cash flows, but for the moment I'm not worried, we'll deal with them later. Exercise 2, it says suggest other factors that need to be considered. Talked about advantages, disadvantages. I'll talk about all that all together. I'm not going to write it all on the screen. But first of all, we are only looking at cash flows. Now, although I said at the beginning, it's cash we need to pay dividends, it's cash we need to grow the company. Shareholders, they tend to look very much at profits. We give them a profit statement every year. First thing they'll look at is the profitability. So shareholders stand to be interested in profits, and this isn't considering the profit itself. Although, in principle, this is by far the best approach. Secondly, of course, as with any measure, it's all based on estimates. Estimates of all those cash inflows, of course, any of those turn out to be different. The NPV would be different and potentially we've made the wrong decision. There's also a big problem about the cost of capital. We'll discuss later, but it's very hard to calculate a cost of capital accurately. And if it's not 10%, if it turns out it's 11%, then there would be a different answer. Maybe it's negative, and we've made the wrong decision. And we always assume it stays constant. Of course, even if it is 10% now, it doesn't mean it would always stay at 10%. So lots of problems. And of course, we only look financially. We've not looked at any other considerations, such as I remember one exercise a long time ago, but dealing with a company that was having to pay fines because they were polluting. And they were estimating the fine they'd pay. And overall, was it cash surplus, cash deficit? And of course, we've ignored factors like environmental pollution and so on. We're only looking at purely financial ones. Anyway, one of the factors I said there that was a problem is the cost of capital. Accept my word for it for the moment that in real life, because companies borrow money from various sources, they borrow money from shareholders, they borrow money from long-term debt, long-term borrowing, it's virtually impossible for a company to calculate the cost of money accurately. We might think it's about 10%, but it might be 11, it might be 12, it might be 9, and so on. And so, what's very common is to effectively calculate a break-even cost of money. And this is called, it's on the next page, the internal rate of return or the IRR. Now, before we discuss how we use it, and I repeat in more detail what I was saying a minute ago, the definition, the only definition of the internal rate of return is it's that rate of interest at which the net present value of the project is 0. So that's what we're after here. Before we discuss the importance and relevance of it, we know if the rate of interest is 10%, the NPV is plus 6660. You also, I hope, agreed with me, if the rate of interest is any different, if it's 11%, if it's 15%, if it's 4%, I think fairly clearly you'd end up with a different net present value. And I want to know what rate of interest would end up making it 0. Well, firstly, have a think. Would you expect to get NPV 0, would you expect the interest to have to be more than 10 or less than 10? Well, I think it should be clear. To get 0, it would only happen if the rate of interest was higher. The more expensive money is, the higher the interest rate, the lower will be the NPV. Well, I want to know when it's 0, and what we do, let's make a guess. Look at exercise 3. Using the same project that we've just done, NPV 6660, calculate what the NPV would be if the interest was 15%. So why don't you do it? Pause and then check back. Or if you don't want to pause, watch me, but I'm not going to waste time. It's exactly the same cash flows. So we pay out 80 and we get back, and I have to check the question, we get back 20 in 1 year, 30 in 2 years, 40 in 3 years, and a total of 20 in 4 years. There's 10,000 from cash profits, there's 10,000 from scrapping. I want to work out the present value at interest of 15%. And so using the tables again, 80,000 now has a present value of 80. At 15%, for 1 year, the discount factor is 0.870, for 2 years, 0.756, for 3 years, 0.658, for 4 years, 0.572. giving present values of 17,400, 22,680, 26,320, and finally 11,440, which gives a net present value at 15%, 17,400, 22,680, 26,320, 11,440 minus 80,000. 2,160 negative. So, as I expected, with higher cost of money, there's a lower net present value, and in fact it's gone negative. Had the interest been 15%, we would have rejected. However, what I want to know again is at what rate of interest would the NPV be 0? Now, one way you could do it, if I can find the pen, you could, if you wanted, try lots and lots of rates and draw a graph. I was going to take this down, but if I did draw a graph of the NPV as against the rate of interest, there's naught, there's positive, there's negative. If you went through and worked it out at 1%, 2%, 3%, 4%, and so on, what you'd find is the NPV would fall, but it would be a curve. If you don't believe me, then there's something for you to do after you finish this lecture. Do a whole series. We've only done 2. We did it at 10%. And we got plus 6,660, I think. I also did it at 15. And we got minus 2,160. But again, if you did do a whole series of them, you would find you got a graph something like that. And what we're after, by definition, is when the net present value is 0, the internal rate of return. But of course, you could draw a graph and read it off the graph. In the exam, even in real life, we never do. What we do is from our 2, what you might call guesses, we approximate between them. We interpolate as though it's linear. And so, because it isn't in fact linear, the answer we get is only ever approximate. But as you'll see, that's really all we need. But we're going to approximate between the 2 guesses we've had. Now, there is a formula you can learn. It's underneath exercise 3. And it's right. I personally hate learning formulae, because you're not getting it in the exam. And this is one area where I think once you understand it, you don't actually need a formula. The trouble with the formula, you remember it wrongly. So it's entirely your choice. I am not going to write that formula on the screen. I'll just use our 2 guesses. We did 2 guesses at 10%. The NPV was plus 6,660. We then did it at 15%, and it was minus 2,160. And so, over a change of 5 percentages, the NPV fell. It fell from plus 6,000 to minus 2,000. So it's fallen by a total of 8,000 and whatever. 0, 2, 8. It's fallen by 8,820. $8,000 a fall is equivalent, we say, to 5 percentages. Well, now I can write the internal rate of return down. We simply apportion. We knew it was more than 10%. 10% it was positive, to end up with 0, it must be a higher cost of money, higher than 10%. We need to get to 0, we need the NPV to fall by 6,660. We know that 8,820 is 5%, so 6,660 is this proportion of 5%. You know, if I just talk about the thousands for a second, we need it to fall by 6,000 to get an NPV of 0. We know that a fall of 8,000 is 5%. Fine, a fall of 6,000 is 6/8 of 5%. So a portion between, and what do I get? I get 13.78%. Now, a couple of things about that. Firstly, that is only approximate. It seems a bit silly leaving 13.78 and then saying it's only approximate. Generally, in exams, we write it to 2 places. But do be clear, it's only approximate because I've already said it's not linear. So normally in real life, I'd say it's about 14%. And secondly, the relevance of it, there you are about the linearity, you know, again. The relevance is this. We thought, for our example, we think the cost of money is 10%. And at 10%, it's positive and we accept. But I said it is possible, it's likely that we don't know the cost of money exactly. What happens if it's 11? What happens if it's 12? And so on. Well, if it's 11, if it's 12, the NPV will be lower, but provided it's still positive, then we're still happy to accept. There's no problem. But if ever it became negative, then of course you'd want to reject. Well, we've calculated the IRR at, what was it, 13.78%? About 14. And so, if I'm not certain about the cost of money, and we usually aren't, what I can say is that this project is worthwhile provided the cost of money is less than 13.78. If the cost of capital is less than 13.78%, then okay, we will accept. If it's more than 13.78%, we'll reject. And it's very much a risk thing, to be honest. You see, I think it's about 10%. If the internal rate of return was 11%, I'd actually be very scared of doing this project, because a tiny change in the cost of capital and it would be negative. On the other hand, if the internal rate of return was 20%, all right, I think the cost of capital is 10. I may be wrong, but I don't think there's much chance of it being so much wrong and being more than 20%. There'd be much less risk. I'd probably be perfectly happy to go ahead. So that's the real relevance. It's sort of break even. And as I said, we never draw graphs or anything. You calculate it by making 2 guesses and approximating between them. Which 2 rates you use doesn't matter. If the exam, as it's quite likely, tells you, as my example did, to use 10% and 15%, then obviously you do. If they don't tell you, then any two guesses, because it's not linear, the final answer may be slightly different. That doesn't matter. It would never be a lot different. So, you could here have guessed, I don't know, 8% and 16% or something. The internal rate of return would be a little bit different, but it would still be somewhere around 14. It won't make a big difference. Anyway, that's internal rate of return. Now, I'll pause the lecture here, but in the next lecture, we'll look at a variation of that called the modified internal rate of return. So we'll have a break here, but in the next lecture, I'll go straight on with the rest of the chapter.